Hi class, let me give you a brief introduction for chapter 10. And this week our assignment is about chapter 10, chapter 11. Chapter 10 is about capital budgeting. We have learned a whole lot of this subject in fin534. If you haven't yet, you can go to my website, go to jufinance.com and look for this class, fin534, so you can find and click on it. Go to chapter 10, so you can find the equations like MPV function, IRR function, and payback period function. And also you can find the calculator and go to the website and click on the calculator for MPV, this one under capital budgeting. So not capital budget, under MPV, MPV IRR. And so I got 3 calculators here. So one is MPV IRR, so you can use it to calculate the MPV IRR payback and period. And another one is the Excel. And this is the Excel. So if you click on it, so you can find the template for capital budgeting questions. So this is a new one I added here. So what you can do, you can just put down each year's cash flow from year 0 and year 1, year 2. This is a frequency. If year 1's cash flow repeated for more than 1 time, so you put the frequency here. So, and then you also put the cost of capital here and then calculate. It will tell you how much is MPV, IRR, payback, MIR, and discounted payback period. In this class, we just need MPV, IRR, payback, and MIR. We don't need to calculate discounted payback, but we did it in fin509. Anyhow, so this chapter is not that hard to understand. So I'm not going to explain about the homework of this chapter. Let's move on to the next chapter, chapter 11. It's cash flow estimation and risk analysis. So it's like a accounting chapter. So you need to figure out the operating cash flow. In the class website, I have an exercise. You can give it a try. I also post the solution here. You can use it as a template. I have a template here for that question. So operating cash flows equation is also given. Okay, so what I want to do is let's look at the homework question. Let's start from there for the description questions, and I'll show you what is the correct answer from the answers, and I'll explain to you the concepts for this mini case. Okay, so this mini case is a company is considering adding a new line to its product mix. Capital budgeting question is it's a capital budgeting question, and so the cost is given, and also the increases in sales are given. The way to do depreciation, shipping costs are all given, and also the salvage value after 4 years of use are given. And based on the information, asking you to do the estimations of the cash flow for this project in the 4-year period. Okay, so now this is a case study, and you need to calculate the cash flows every year. So the first question, define what is incremental cash flows. So the definitions, it's also in the textbook. Incremental cash flows is the cash flow with the project minus the firm's cash flows without the project. And if there's interest, expenses, and dividend, shall you subtract these when calculating project cash flows? The answer is no. And the reason is because the return required by investors furnishing the capital is already accounted for when we're applying the 10% cost of capital discount rate. So don't subtract interest and dividend. Otherwise, you're double counting. If we deduct capital cost in the table and thus reduce the bottom line cash flow and then discount this cash flow by the cost of capital, we would in fact be subtracting capital cost twice. That's why. And second question, suppose the firm had spent $100,000 last year to rehabilitate the production line site. Should this cost be included in the analysis? The answer should be no, because this is a sunk cost. Sunk cost will not be considered for the cash flow, for the cash flow estimation. But the next question is opportunity cost, and it should be considered as part of the cash flows. So the space could be leased for $25,000. The next question. So because this is opportunity cost, if the company, because it's incremental cash flow, so if the company don't take this project, and then the company can make $25,000 for from leasing this place. So this is the opportunity cost. So this should be part of the cash flow estimation. So, but since there is a tax, so this is tax. So, so you see here, the opportunity cost cash flow must be net of taxes. So it would be $15,000 annual cash outflow. So we should subtract this from the cash flow estimation. The next one, if the sales is expected to be decreased by $50,000, and shall this one be considered in the analysis or not? This is an example. Externality, so it should be considered in this. So sales would be decreased by $50,000. Then it's a cost to the project. Yes, so we should consider this. We should consider the $50,000 as externality. So only some costs will not be considered, but opportunity cost and externality cost should be considered. This is this one. And interest and dividend will not be considered because of the double counting. Okay, so how much is the depreciation? So we should consider the asset depreciation, the base for depreciation. So it should be, you see here, so if we added shipping and installation fee, so it should be $240,000 depreciation base. And then the rate are given. So so here, so you see this table give you depreciation rate. So it's different rate, a different percentage each year. So it's heavily depreciated in the earlier period. So it add up to the total depreciation value, 240. Now this is B. And for C, it's asking you to calculate the annual sales, revenue, and cost. Okay, so it's a 3% increase. 3% of increase for both revenue and cost. So see over here, I give you year ones and year twos. So there's a price will gone up, units the same, price gone up by 3%, unit cost gone up by 3%, and then so you can calculate using units multiplied by unit price to get sales, units multiplied by unit cost to get unit cost. And year 3 will be another 3% increase for unit price from year 2, and year 4 will be another. So year 3 and year 4, these numbers should be 3% more. And then you can calculate the the sales and cost. So why we should consider inflation, the cost. So we do consider the price will go down up by 3%. So the number of units will not be changed. So we should consider the inflation. And now we could. We are here. We can create a table. We can create a table like this: sales minus costs, minus depreciation. So what we got is operating income, or EBIT, and then we consider the tax 40%, and then so we got after tax EBIT. After tax operating income, and then we add back the depreciation. We need to add back depreciation because this is we're calculating operating cash flow, so we need to add back depreciation, and then we got operating cash flow. So this is so because of sales and costs for year 3 and year 4 should be 3% more, and the depreciation are discounted at different weight percentage. So depreciation for year 3 and year 4 will be different, and then so you can just use this table and fill it up for year 3 and year 4. Now after we do this, so the next question is asking you to calculate the net working capital requirement. If the company increased net working capital, and that's an increase, net working capital equals to current asset minus current liability. If there is an increase in net working capital, then it costs the company the cash to purchase, to increase its net working capital. So it costs the company has to spend money to increase its net working capital. So if there's an increase, the company's cash flow will be reduced. So you see, year 0 there's no sale, but year 2 and year 3. So there's also year 3. It should also has we should have year 3 and year 4. You can fill it up, year 3 and year 4, and net working capital will be 12% of the sales. So you copy the sales from previous table, net working capital should be 12% of that, and then you compare like year 1, year 0, there's an increase of $900 of increase in net working capital, and that's $900 lower for cash flow because there's an increase in net working capital. There's a decrease for cash. So the first year 0's increase, of net working capital $30,000. You can consider this like the company has to get some products ready for sale at year 0. So since they increase the net working capital, they have to spend the money to prepare the inventory or have this net working capital ready. So it's a decrease in cash. So the firm decreased $30,000 of cash, so they can have net working capital worth of $30,000. So you can just use the difference of year 1 minus year 0, and if it's a positive number, and that reduce your cash flow. And then year 2's, you can get the difference of year 2's minus year 1's, and there's an increase of net working capital of 927. So it's a decrease of cash of 927. So you can continue. It seems like this one should be 3% more, and year 4 should also be 3% more. Now we got the net working capital, net operating cash flow from year year 1, 2, 3, and 4. There's no year 0's net operating cash flow because there's no operation. We also got year 0 to year 4's net working capital. There's year 0's net working capital because at year 0, so need to have the inventory kind of a current asset and ready. So there's net working capital here. So the last thing we should consider the salvage cash flow year 0, year 5, year 4. The after-tax salvage cash flow should be at year 4 because the company will liquidate their asset by the end of the project. So it's $25,000 is the equipment value, but however, since we fully depreciated this asset, $240,000, it's fully depreciated by the end of year 4. After depreciation, the net depreciation value of this should be 0 at the end of year 4. So by the end of year 4, it should be $0 value, but the company could sell this asset for $240,000, so $25,000. The company sold something which is 0 value for $25,000. So the company need to pay tax, 40% of the tax. So you see, salvage value is $25,000 from something worth $0 after depreciation, and tax, since this is the income, so they have to pay $10,000 of tax. So the difference between the two should be the net after-tax salvage cash flow should be $15,000. This number should be $15,000, and then so this is year 4's after-tax salvage cash flow. So we should add part F and part E and part D together. That will give us the whole picture of the cash flow. And we also need to have the year 0's cash flow for the price paid for the asset to start this project. Yeah, initial outlay. So this is the whole picture. The net cash flows, year 0's, there's an initial outlay of $240,000 because of the increases in net working capital. So this is year 0's cash flow. Year 1, there's only operating, and also increases in net working capital. And year 2 and year 3 and year 4. So year 4 it has not only the operating, year 4 operating increases in net working capital, decreases in cash flow for that part, and also there is the salvage cash flow. Bring this down here, and then you add it together. Let me show you how much it should be, but you can fill it up here. So this is the cash flow, but you filled it up this part, and then use and the discount rate is, use the discount rate, and then so you can and this is your cash flow, and then you can calculate the NPV, IR, and MIR, and the discount rate should be 10%. So use this 10% as the cost of capital WACC here. So this is this project. If you have any questions, let me know. Yeah. Okay. That's all. That's all for this mini case. It's a pretty typical one for like the firm was taking a project like that, and then the procedure is just like this. So you need to calculate. The operating cash flow And also you need to calculate the net working capital changes and cash flow related to that. And also you need to calculate initial outlay and salvage value. And then put them all down in one table, and then calculate the NPV. If NPV is positive, and that means this project is worth taking. So, well, that's all. Thank you for watching.